Hello friends and welcome back. Friends, in the first part of the video, we have learned about different types of funds and the risk and returns associated with each of them. You have learned to identify the types of funds based on your needs, goals and risk profile. If you have not watched the first part of the video, do watch it now. Link of the video is given in the description box. So now coming to the main point, how to choose the best funds in a particular category. Answer is simple. How do you buy some other stuff? So while buying anything new, first of all, you see the credibility of the shop where you are buying that stuff, right? So in case of mutual funds, we are going to learn how to check the track record of the fund manager who is managing a particular fund. Second thing which you do is cost benefit analysis. Similarly, to buy mutual funds also, we will do cost benefit analysis. So first, we will see what are the costs associated with a particular fund, and then we see what benefit we are going to get out of it. So for mutual funds, it is what returns are we going to get on our investments. But when it comes to investments, we also see if you are getting X percentage of return, how much risk you are taking to get that X percentage of return. So we'll learn to analyze mutual funds returns in relation to risk we take. So today we are going to learn how to analyze the returns from mutual funds, what is expense ratio, how to see the track record of the fund manager, and certain ratios which will help you to determine the returns as compared to the risk taken. So let's begin. Why do we invest? What is the main purpose of investing? Yes, to save and get better returns, right? So the first thing to see is return on a fund. Now, suppose a particular fund has given a return of 15% for the last 1 year. Now, how to know whether this return is good or not? So for that, you have to compare the fund's performance with its peers. So for example, suppose you are looking at equity savings funds and you are going for direct plans. Here, let me tell you the examples I am giving are only for illustration, so don't take it as an investment advice of any sort. In practice, there are many peers for a particular mutual fund scheme, but for the purpose of simplicity, we are considering only 3 funds. So as you can see on the screen, if we compare the 3 funds, HDFC funds last year's performance is better than its 2 peers. You can clearly see, right? But is it enough to see only last year's performance? No. You also have to ensure that the fund's performance has been consistent over the past years. So it is possible that a particular fund has given good returns in the last 1 year, but if you see average returns of last 3 years or say last 5 years, it is possible that it has not given similar returns. So in our example on the screen, if you compare, you will see that although returns of Mirai asset for last 1 year are slightly lower than the other 2 funds, but if you see for the last 2 years and 3 years, returns of Mirai assets are higher as compared to other 2 funds. So you also have to see whether a particular fund has consistently given good returns. You can also do this analysis by visiting free websites like moneycontrol.com. So based on these 2 parameters, which are past returns and consistency of returns, you can compare the funds as far as returns are concerned. So as I said, you should look into a fund's history and choose fund houses that have performed consistently over a long period, say 5 years to 10 years. However, remember that the past performance does not always guarantee future returns, and the future returns are dependent entirely on the market movements and fund managers' decisions. A fund's performance is reflected based on the quality of stocks in its portfolio and its benchmark. Now, you know that the fund's performance is also dependent on the fund manager's approach for investing. You can learn about a fund's investment strategy by reading its fund facts and prospectus. You can go to AMFI website, and from there you can go to a particular fund's website and download these documents. Generally, there are 4 common approaches to investing. First is top-down approach, wherein the fund manager looks at the big economic picture and then finds industries or countries that are going to do well, and then invest in specific companies within the chosen industry. In case of bottom-up approach, focus is on selecting specific companies that are doing well, no matter what the prospects are for their industry or the economy. The third approach can be a combination of top-down and bottom-up approaches. Under technical analysis approach, the fund manager attempts to forecast the direction of investment prices by studying their past market data. So it is very important to know who is the fund manager of a particular scheme of mutual fund and what is his past track record. You can check this by going on moneycontrol.com website. Here you can choose any fund and then go to scheme details. Here you will get names of the fund managers managing that particular scheme. If you click on a particular fund manager's name, you will get details of all the funds managed by that fund manager and its past performance also. Third important factor for choosing a particular choosing a fund is its expense ratio. Expense of the mutual fund house comprises management fees, which is basically the amounts paid to fund manager for their expertise, and which is generally 0.5 to 1% of the fund's assets, and the administrative expenses and distributors' expenses, which is the commission paid to distributors. So expense ratio is calculated by dividing the total amount of fund fees, both management fees and operating expenses, by the total value of the fund's assets. The expense ratio depicts how much of your investment goes towards managing the fund. So a lower expense ratio obviously means higher take-home returns. Therefore, if there are two funds with a similar track record and asset allocation, you need to choose that fund which has a lower expense ratio. You can get this data on websites like moneycontrol.com. As you can see here, along with expense ratio of a particular scheme or fund, you can also see average expense ratio in that particular category. So here also you can get a comparative idea. So friends, till now we were talking about only the returns. So you would say, since higher the risk and higher the returns, shouldn't we see the returns as compared to the risk we are taking? Therefore, now we are going to discuss my favorite topic, which is ratio analysis. If you see websites like moneycontrol.com and see details of any fund, you can get to see 5 important terms, which are standard deviation, beta, Sharpe ratio, Jensen's alpha, and Trainer ratio. Does it sound technical and complicated? Don't worry, it's not as complex as it sounds. We'll discuss and learn one by one. So starting with standard deviation. Standard deviation is a tool that tells you how much the return from a fund can deviate from its average return based on its historical performance. For example, if a particular fund has an average return of 12% and a standard deviation of 5%, it means that it has a tendency of deviating by 5% from its expected average return and may give returns between 7% and 17%. So higher the standard deviation, more volatile it is. So if particular scheme or fund has higher standard deviation compared to similar schemes of other funds, it is more risky. Now coming to the next parameter, which is beta. Beta of a mutual fund scheme is the volatility of the scheme relative to its market benchmark. So suppose a fund's benchmark index is Nifty 50, and if the beta of that fund is more than 1, then the fund is more volatile than Nifty 50. If beta is less than 1, then the scheme is less volatile than its benchmark. So a fund with a higher standard deviation and a beta is riskier than a fund having lower standard deviation and beta. Now coming to Sharpe ratio, you know that there is certain amount of return which you can earn without taking any risk, right? Like if you invest in government securities, so if you invest in government securities, you will have say 5% to 6% of return, which is risk free. Means आपका पैसा कहीं भी नहीं जाने वाला है, you know. So you can say that whatever return you earn over and above this risk free return is earned by taking some risk, right? So the important thing to understand is not how much this excess return you earn, but how much excess return you earn relative to the risk you take, or in other words, how much excess return you earn per unit of additional risk you have taken, right? So there comes Sharpe ratio. It will tell you how well your mutual fund portfolio has performed in excess of the risk-free return. The Sharpe ratio is calculated by subtracting the risk-free return from the portfolio return. Afterwards, the excess return is divided by the standard deviation of the portfolio returns. This essentially gives you an idea whether your returns are due to smart investment decisions or these are due to excessive risk. So in nutshell, higher the Sharpe ratio, the better the risk-adjusted return of your mutual fund. So you should choose funds with a higher Sharpe ratio as they offer higher returns for the additional risk you take. And here, the fund manager play a very crucial role. Now, coming to Jensen's alpha. Now, Jensen's alpha is basically excess return earned by the mutual fund from the risk-free return as adjusted by beta. So suppose a fund has given a return of 15%. Now suppose during the same period, its benchmark index has given a return of 12%. And suppose the beta of the fund versus the same index is 1.2 and the risk-free rate is 6%. So the Jensen's alpha in this case would be 1.8%. So what does it indicates? So here beta of the fund is 1.2, which means it is expected to be riskier than its market index. But the positive alpha of 1.8% indicates that the portfolio manager earned enough returns to be compensated for the additional risk he has taken. If in the same example, if the fund delivered a return of 12%, the alpha computed would be minus 1.2%. And here, the negative alpha indicates that the fund manager was not earning enough returns for the quantum of risk he has taken. Similarly, an alpha of 0 would then indicate that portfolio or fund is tracking perfectly with the benchmark index. Now coming to tenor ratio. The tenor ratio, also known as reward to volatility ratio. Now similar to Sharpe ratio, it is also a performance matrix for determining how much excess return was generated for each unit of risk taken. So higher the tenor ratio, better it is. So tenor ratio is similar to Sharpe ratio. The only difference is that in case of Sharpe ratio, we use standard deviation in the denominator, but in the case of tenor ratio, we use beta in the denominator. But what does it mean? So there are two kinds of risk: unsystematic risk and systematic risk. Unsystematic risks are specific to the company or industry. Then there are systematic risks like inflation, interest rates, government policy, etc., which apply to the entire economy. So while standard deviation measures the total risk of the portfolio, the beta measures the systematic risk. Therefore, Sharpe ratio is a good measure where the portfolio is not properly diversified, while tenure is a better measure where the portfolio is well diversified. Now you can check all these ratios on a free website like moneycontrol.com, wherein you can also compare these ratios among the different schemes in a category and make decisions accordingly. So friends, even after doing all this analysis, since mutual funds invest in equities, they carry some risk. And as you know, investment is all about risk management. So diversification can help you to reduce risk associated with investment in mutual funds to a certain extent. Secondly, the risk can be mitigated to a great extent by staying invested for a period of 5 years. In my view, investors are advised to stay invested for a minimum of 5 years to reap the best returns offered by mutual funds. This way, you will give your investments the much needed time to go through the market cycles and provide excellent returns in the long run. Also, as I said in the first part of the video, if possible, it is always better to take help of a registered advisor for your investment planning. So friends, just to summarize the today's video, we have learned that while selecting a particular fund, you should compare it with its peers. You should also look at whether the returns are consistent. Lower the expense ratio, better it is. At the same time, you should also look at the fund fact sheet and prospectus. Fund manager's track record is also important. We have learned that lesser the standard deviation and beta, better it is. A positive alpha indicates the returns are enough to compensate for the risk taken. We have also learned about Sharpe ratio and tenure ratio, which are excess returns earned by the fund for per unit of risk taken. Now, higher these ratios are, better it is. And lastly, we have learned that you can reduce the risk by diversification and investing with a long time horizon. So friends, I hope the video was informative. Bye and take care.